Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we are taking a look at Keurig Dr. Pepper. There was a request to look at this stock, so we're going to dive in, see what a fair value is, and some growth prospects. Coming up with a fair value of 34.25 and a current price of 30.43, discounted cash flows of 34.22, so clearly a good price for this stock would be right around the $34 mark. And it's sitting at just shy of 30 and a half right now, so that's not bad. It's been as low as 27.66 and as high as just about 36 in the last 52 weeks. So pretty tight range there. It basically looks like it's priced to perfection as we get into this. Earnings yield, that's fine. It's not incredibly undervalued. It's not overvalued. It's a decent value. Cash flow yield, they clearly spent a lot of money this last year, so their cash flows dipped, but typically they're pretty good, around 14. Dividend is currently slightly above the average. It's at 2.8%. Usually it's around 2.7. Payout ratio 45.53. So it is creeping into the higher end of what we'd like to see for a payout ratio for a dividend. So not a huge worry there. I wouldn't expect massive growth going forward. This looks to be more of a blue chip dividend stock. ROE looks really good, 8.49, and the debt to equity isn't insane. It's right around 1, so that's not bad. Definitely one of the better ones that we've seen. Their balance sheet, it's in pretty good shape. ROI is a little low, 3.5%, and ROA 4.2 or so percent. Both of those, I'd say, are pretty low, but that's not a deal breaker. Margins, gross margin, 54.54, really good. Up above their average of essentially 54.4. Net margins came in pretty high this last year, 14.72, typically 13.32. So margins look really good here. We like to see 30 and 10, 50 and 15 are pretty good. Revenue growth, analysts are projecting to slow down going forward as we see 8.4, 5.3, and then both the 1 and the 2 year, they're saying around 3.75 or so percent. So we're going to use that for the thesis. Share count, they are buying back shares to a small degree. It has picked up more recently. If they're allocating the same dollar amount, that's no surprise. So we're going to go in line with that with a buyback of 0.7%. The larger that this gets, the better. It could potentially be larger. It depends on at what point they're buying back shares, where the price is sitting at that point in time. Cash flows, they did have a down year for cash flows. So if we want to bring it back up in line with what we've seen historically, they're going to have some pretty good growth coming back out of that. So we'd be looking at that 25% just to get them back to their average. And they could go above that. They've gone to 17 previously. So this could be 30% year-over-year growth. Assets, 1 to 1.5%. We're going to stick with that, 1.25. Liabilities, growth between 0.5 and 1, 0.75 for the thesis. Dividend growth, I do think it's going to slow down. They don't do massive raises, maybe 4 or so cents per year, which at this point would be a 4% raise. So we'll stick with that going forward. That would take them to $1.05 in 5 years, and you'd be sitting on a yield on cost of 3.4%. That's not bad. I think 2.83 is a little low for a dividend. Personally, I like to see 3 to 3.5. 3.4 is a decent yield on cost. And then margins, they're already really high, higher than their average on the net margins. So if they can keep that up, get some small growth out of it, 1% is not a whole lot, but it'd be nice if they can continue that trend with growth. So if you're buying it at today's price, the growth in the fair value, assuming our thesis, would be essentially in line with markets. You get a small 1% beat over the 3-year. This is with dividends factored in as well. And then in 5 years, you're right in line with markets, getting a 47% return. So the average annual return here, 5.45%, but once you factor in the dividends, you're looking at 8.28. There's not a whole lot to complain about here. You're getting returns in line with the market. Granted, it's only really there because you're getting that dividend, but they're only growing their revenues 3.8%. If you really want growth, they need something higher than that and some more buybacks for shares. Maybe even lowering those liabilities rather than raising them. And the situation would get even better. If I had anything to complain about here, it'd be the low returns. ROI and ROA are pretty low. And like I said, debt to equity is right on the cusp of where we like to see it. That 1 and below is ideal. So now if we take a look at the prices, see if anything looks strange. Cash flows, like I said, dipped this last year. Get back in line. We were assuming that it'd take up to 5 years to get them back in line, so that could grow even faster. The dividend has a nice linear growth here. The fair value sitting right there in the middle. Again, nice linear growth. Earnings dipped down in 2022, and going forward, some decent growth. And the balance sheet up above everything else, very linear. So this is a very good company. The cash flows here are the only issue. And I mean, if we wanted, we could really dig into that and see why were their free cash flows lower this last year than they've traditionally been. Maybe they were doing some big investment that could help drive those revenues. They could definitely use those cash flows and pay down these liabilities, buy back shares, and it'd be a pretty good situation here. So this is kind of an ideal case for a blue chip stock here. Valuations right where we like to see it. You're getting returns in line with markets. So if they can beat this in any way, you're probably outperforming the market. And I don't really see a case where they underperform this. This is a pretty conservative case here, but it is possible. So I want to thank you guys for watching. Please like if you enjoyed the video. Comment what other stocks we should take a look at and subscribe so you can stay up to date with everything. And I'll catch you next time.